Okay, SPGI is the ticker we're talking about on New York, and it's the S&P Global company. So everyone knows the S&P. We quote the S&P 500 every day. How's the market doing? It's usually the S&P that we look at. It's kind of the global, or the gold standard, I should say, for indices, along with the Dow Jones. And we're still looking at names that can really work in this environment, that are actually doing okay, at least not getting killed in this environment. And we still think it's too early to look at names that have been badly beaten up but could be later cycle. So, for instance, autos. Autos, I have nothing against the auto industry. I think it's a pretty good industry, but I think it's a later cycle. Like, no one's rushing out to buy a car right now, right? I mean, we're not even driving, most of us, right? Like, not at the same rate. We're not commuting to work. We're not doing a lot of things. So nobody's really looking to buy a new car right now. So that's later cycle. There'll probably be a great opportunity to buy those. I just don't think you need to rush into them. And we'll look at those down the road. So we want to get things that are working right now. And very pleased to say S&P Global is working quite nicely. We just got the Q1 data in. It was a nice surprise. It did better than I would have expected. Bullish rhetoric on the call, and I really think it's going to do well. It's actually rebounded almost to its former, not quite its former high, just before the drop. It was kind of at its high just before the drop. It's kind of its all-time high. Came down precipitously, and I'm not going to pretend I was smart enough to buy it at the low or anything like that. But now that the market has settled in, you can see why this has done well, and I think it continues to do okay. So, a couple of points: they have a ratings agency, and everyone's out there scrambling to get data on which companies are going to survive, which ones are getting downgrades and upgrades, or not that many upgrades, but mostly downgrades. And if you're just kind of staying level or just getting a small downgrade, people are going to look at that, and that's great. They also they license their name out to a lot of ETFs, right? So anything you see with it, S&P 500 ETF or something like that, or they license their name for that. So that's a big piece of their business. Market intelligence, just lots of Wall Street people using their data to analyze stocks. You think about it, that industry has not been that hurt because the market came off really quickly, and then it rebounded, not all the way back, of course, but it's been doing okay. So it looks like Wall Street's going to be okay through this. It's not like the financial crisis in 2008 where it stayed down for a long time. In fact, some banks were going out, investment banks were Lehman Brothers, Bear Stearns was also went down. I mean, there was some tough times, right? It's not like that this time. Okay, so these Wall Street data providers are actually doing quite well. So the quarter, now, granted, the quarter was right at the end. Let me try and phrase this properly. It's a Q1, March 31st. We really didn't see a lot of damage in the market till March 23rd. So it only had maybe a week of really poor Wall Street type data, but that doesn't mean their revenue goes down. But it can affect if the market was down for a long period of time, this would get affected. However, no one was canceling it within a few days of getting services and data just because it was down really quickly and then came right back. So here's some things from the call. Strong financial. Q1 increased 14%, earnings per share up 29%. We have a solid balance sheet and ample liquidity. Can't ask for much more than that. They said nearly 99% of their workforce can work at home. They're not laying off anybody. These are all bullish things. I think this is great. All right, so let's take a quick look in our model, and this has the Q1 data in it now. And we're going to the computer screen. Here we go. Here you see the track record. sailing along nicely back in the day, and then 2008, 2009, yes, returns did come down, but climbed out nicely, and it's been, in the mid 20s to high 20s for 6-7 years now. And this is, the blue is the trailing 4 quarters, including Q1, and it actually is 29% cash flow IRR, return on invested capital. That's the highest it's ever been in this 20-year history, right? Already gave you some stats on revenue. Valuation looks really good. The company said they're in a good liquidity position, and I see that they're pretty low debt, 7.7 billion in debt, but it's a $68 billion company, so no big deal. Or 69 billion dollar market cap, and about 700 million on their balance sheet. So, and they also said some of their services picked up at the end of March. So that was pretty stunning. We get a high quality company. We see the stock has rebounded almost back to its previous high. I wouldn't use that as a reason not to buy it, though. I would actually use this as a reason to get into it, just showing that it has strength. I think that's the main takeaway, is that it came through the quarter. Granted, it was only at the end where it could have been affected. They said it didn't affect them. They're not laying off, so they're bullish on their business. We see that it's a good, high-quality company. We see the market has kind of figured it out as well. You're still getting a little bit below its all-time high. Granted, we're not getting a super discount to what it used to be. But all in all, this is the kind of company that can work in this environment. So SPGI, S&P Global's the name. Thanks for watching our investment video. If you want to improve your portfolio returns, simply subscribe. Or if you're an investment advisor or retail investor and you want help with your portfolio more directly, we can help you with a managed account and manage each and every trade for you.